Gold is on an absolute rampage. It's smashing records, nuking all expectations, and leaving governments and central banks scrambling. This isn't just a rally, it's a paradigm shift. But before you get any bright ideas about selling your kidneys to go all in, remember, this is not financial advice. I'm just a guy on the internet reading the terrifying noises the global economy is making. This is for entertainment purposes only. Do your own damn research. Because this isn't your grandma's simple inflation hedge. Something way darker, more structural is happening under the surface. This is a story about the slow motion death of confidence. Let's break it down. What are we even looking at? $4,380. Let that sink in. That was the all-time high for a single troy ounce hit in mid-October 2025. It decisively breached the historic $4,000 threshold, a price point that was pure science fiction just a few years ago. Per gram, we're talking over $14. Per kilogram, over $140,000. These aren't just numbers, they are a milestone signaling a profound shift in how the world sees risk. To put that insanity in context, that's a face-melting 50% pump in the year 2025 alone. 50%! This isn't a fleeting spike, it's a sustained, high-volume assault, making gold one of the world's absolute best-performing assets. The move has been a brutal vertical launch that just refuses to quit. So the question isn't what happened, it's how the hell did we get here? This wasn't a single event. It's four interlocking forces creating a perfect self-reinforcing feedback loop, a doom loop for the old financial order. Force 1, the macro engine. This is a classic trifecta of support. Inflation is the monster that just won't die. And despite central banks acting tough, it remains stubbornly high. At the same time, the market is betting the Fed will be forced to cut rates soon, pushing real interest rates into negative territory. Think about it. If a bond pays you 3%, but inflation is 5%, you're losing money. The opportunity cost of holding zero-yield gold vanishes. It becomes the superior store of value. Force 2 is the geopolitical premium. The world is on fire. A heightened risk premium is now permanently baked into the price. We've got major power competition between the US and China, creating constant economic uncertainty. We have protracted military conflicts in Ukraine and the Middle East, serving as stark reminders of geopolitical fragility. And we have domestic political instability, like the recent US government shutdown, which erodes confidence and fuels a nonstop flight to safety. Gold has no counterparty risk. Its value doesn't depend on a government's promise, it just is. Force 3 is the institutional shift. This is the big one. The puppet masters are changing the rules of the game. Since 2022, global central banks have been accumulating gold at a record-breaking pace. This isn't a short-term hedge. It is a deliberate multi-year policy of de-dollarization. And the real story, the one that's a long-term structural bomb, is that this de-dollarization is an escape plan. For decades, the whole world has used the same bank, the USA. But the freezing of Russia's foreign currency reserves after the Ukraine invasion was the catalyst. It was a wake-up call. It proved that dollar assets carry massive political risk. Now, nations are looking for a new safe deposit box, an asset with no political counterparty. And that box is made of pure physical gold. Who's leading the charge? The central banks of China, Russia, India, Turkey, and the entire Middle East. The People's Bank of China has been stacking gold for at least 18 consecutive months. This isn't speculative retail froth. This is strategic, long-term, price-insensitive buying. They're building a new foundation for the market, creating a solid and continuously rising floor under the price. Force 4 is investor demand. A massive wave of FOMO from hedge funds down to retail noobs, all piling in through instruments like ETFs. This amplifies everything. When investors get spooked, they can now instantly buy gold exposure, translating market fear directly into upward price pressure. Which brings us to the single most important long-term driver of this whole meltdown, the United States government itself. Let's look at the receipts. The modern era of gold pricing began in 1971 when Nixon formally severed the dollar's last link to gold. From that moment, the national debt went supernova. It exploded from a quaint $400 billion, less than 40% of GDP, to a mind-bending $10 trillion in 2008, and now a catastrophic $37.5 trillion in 2025, representing roughly 124% of the entire US economy. That's not a line on a chart. That's a national death spiral. So what if I told you that death spiral is directly wired to the price of gold? Here's the cheat code: 92%. That's the statistical correlation between US national debt and the price of gold since 1971. This isn't a coincidence, it's causal. Gold is acting as a barometer for America's fiscal sanity, or rather, its complete lack thereof. As the debt rises, global confidence in the dollar's long-term purchasing power systematically dies. And that capital flees directly into gold for survival. This creates the ultimate policy paradox. The US government is trapped in a corner it built for itself. The very actions they take to stimulate the heavily indebted domestic economy, printing money, cutting interest rates, deficit spending, are the exact things that murder the dollar's value on the world stage and bolster gold's status as its only real monetary competitor. The medicine is the poison. But no asset goes vertical forever. The market is now technically overbought. What are the kill switches that could trigger a rug pull? The most immediate threat would be a sudden hawkish pivot by the Federal Reserve, a new series of aggressive rate hikes. Second, a significant de-escalation of global conflicts. If world peace suddenly broke out, the fear premium would evaporate. Finally, a period of robust, non-inflationary global growth. If other assets are providing strong returns, gold's defensive appeal fades. Analysts believe a healthy 10 to 15% correction wouldn't be surprising after a run like this, but they also say it would be a temporary pullback, a buying opportunity. Because even with that risk, the smart money is betting this goes higher, way higher. The big banks are telling their clients the party is just getting started. Bank of America and Soc Gen are calling for $5,000 an ounce. Goldman Sachs is right behind them at $4,900. The most powerful financial institutions on earth are screaming at their clients to prepare for a world where the dollar is weak and gold is king. Which leaves us with one final, terrifying question. After seeing all the drivers, from central bank strategies to massive government debt, is gold's insane price really telling us something new about its own intrinsic value? Or is it just a mirror reflecting our total collective loss of confidence in the stability of everything else? The US government has built a machine that powers its own demise, and gold is just the scoreboard. What do you think is the next domino to fall? Let me know in the comments.